Welcome back to our special edition of In Focus, Funds Under Fire. Today we are examining if mutual funds run by securities firms harmed investors by holding on to stocks longer than normal due to their investment banking relationships. Joining us now to take a closer look are three guests. Ted Seidel is a former SEC attorney and compliance officer at Putnam. He is now president of Benchmark Financial Services, which advises pension funds. He comes to us from Florida. Professor Jack Coffey is a securities law professor at Columbia University here in New York. And from San Francisco, Jerry Dodson, president and founder of Parnassus Investments, an investment company with more than $1 billion in mutual fund assets under management. Well, gentlemen, thanks to all three of you for joining us today. And the first question is going to go to Professor Coffey. What we are speaking of here, this potential link between investment banking relationships and mutual fund decisions, is there anything illegal about this?
Well, if proven, it would be a fiduciary breach. The fund manager has a duty to make decisions in the best interests of his shareholders, not in the interest of the separate underwriting division of the same parent corporation. And if you subordinate the interest of your shareholders by accepting shares in weak IPOs or supporting the price of an IPO by buying in the secondary market when you know the price is likely to be receding, you are breaching your fiduciary duties. But that's just the statement of the conflict of interest. There's got to be more than circumstantial evidence. Right now, we're still at the early stages of this investigation.
Mr. Seidel, from your point of view as a former SEC attorney and now working for a pension fund, do you think there's anything illegal going on here? I mean, the reality of the situation is these banks underwrite a lot of issues, and it's almost impossible to avoid owning stocks of clients.
Well, that's right. And throughout the 1980s, the mutual fund companies that had affiliated investment banks lobbied the SEC to ease the restrictions. They argued that it was actually hurting the shareholders of the mutual funds to not allow them to participate in these affiliated underwritings. Unfortunately, I think that the SEC went too far in the other direction and basically opened the door to all sorts of abuse.
Well, Mr. Dodson, I want to ask your view as a portfolio manager here, a portfolio manager not at an investment bank. Do you think that this was going on in any sort of way? Again, want to hinge on this issue of whether anybody did anything wrong, whether any banker explicitly said, hey, you got to buy this stock and you have to hold it because we have a relationship.
I doubt whether something like that happened. If there was an abuse, it was probably indirectly, in the sense that the underwriting division of the investment bank probably called one of the portfolio managers and said, hey, let's stick together, we need to get this issue sold. So I think it would be sort of indirectly, because I don't think any of the investment banks under question would actually direct their portfolio managers to buy and hold shares in clients' companies.
So, Professor Coffey, from a legal perspective, what would be a smoking gun in your point of view? Attorney General Elliot Spitzer told me earlier today he's not looking into this, and he's certainly been the one looking into people's emails. So, what would be a smoking gun in this case?
Well, it would be predictable that fund managers would resist pressures from underwriters to dump weak stocks into their mutual fund, because fund managers are compensated based on their performance and the amount of assets under management. And if their fund does poorly, assets are just going to pour out the door. Therefore, if there was this kind of pressure, I think there would be emails in which there would be fights over it, discussions. Some retired employees would come forward and acknowledge that they were pressured. We're not yet at the stage that Elliot Spitzer was when he announced his complaint against Merrill Lynch and Henry Blodgett last year, because he had found smoking guns in the form of employees complaining about their investment recommendations. And I think the nature of emails are such that there would be those kind of complaints if there is a real, actual basis for, again, charges that at the moment are largely based on circumstantial evidence.
All right, so I'm trying to figure out what it would take to get to that point. And Mr. Seidel, I want to direct this question to you because you testified in front of the Congressional Banking Committee, and they are the ones asking the SEC to do a formal investigation here. What did you tell them? If it's not illegal, for example, is it just plain wrong?
Well, it is illegal and it is wrong. And I would disagree with Professor Coffey that I think that fund managers are not purely compensated for the performance of their funds. And in fact, some extremely poor performing fund managers are compensated very handsomely. fund managers are often compensated for the benefits they provide to the advisor that employs them, which may or may not be good performance. So I think that the evidence that David Dietz at Bloomberg uncovered is very damning, and it suggests very strongly that there is a link between investment banking and running these funds, and I believe that it's something the Senate and the SEC should look very closely at.
Well, it's interesting because, Citigroup in their response, they said, hey, you guys kind of arbitrarily picked 4 stocks. We have thousands of stocks in these funds, and we've done thousands of deals. How do you make the argument here of a link on say, 4 or 5 issues then? And I guess, Mr. Dodson, why don't you start off with that?
Well, they do have a point. I think Citigroup has a point that there were only 4 stocks in there. So I don't think you can draw any firm conclusions from the evidence. But I think David Dietz has pointed out a very unusual pattern in that the mutual funds related to the investment banks did have a much higher proportion of stock in clients' companies than you would expect to find in, say, from an independent firm, such as a Fidelity or a Vanguard or even our own fund, Parnassus. So for that reason, I think there is something unusual that needs to be explained. And it hasn't been conclusive, but I think that there's probably something there. But it's definitely, I think, Citibank is right. It's not completely conclusive at this point.
Well, Mr. Dodson, it's interesting because you coming from the other side of this, being an external fund manager here, Credit Suisse First Boston, for example, paid $100 million to settle allegations that they gave favorable IPO allocations to fund managers like yourself, external ones to the company. Here we're arguing the opposite, that they're dumping bad stocks on their own funds. Let's talk a little bit about, in terms of size and scope here, $100 million to settle the allegations of hot IPO allocations. Do you think we're looking at any sort of a numerical settlement here, even if we don't formally have an illegal problem?
To get a settlement, I think prosecutors or the SEC would really have to discover more than we have to date. In other words, we would have to see an email, we'd have to have a testimony from an individual that worked with a money management firm linked to the investment banks. You need something else, I think. If that were the case, though, I think that in terms of numerically, as you said, the fine could be quite large, on the order of what you're talking about, hundreds of millions of dollars.
I want to talk to you all three about potential solutions here, because even if no one was doing anything wrong, clearly there are some ambiguities in terms of the prospectuses here from these firms. Investors can't really know, for example, from a Goldman Sachs mutual fund prospectus, how many of the stocks in that fund are clients. Do you think that perhaps the solution here is more disclosures like banks do in their investment banking research now? And I guess, Professor Coffey, from a legal perspective, I want to start with you on that one.
Well, this has been a problem that's been around for 30 or 40 years. It started out with discretionary accounts. If you go back to the 1970s and the 1980s, you would find that weak IPOs were often stuffed into discretionary accounts because relatively passive owners didn't follow closely where their funds went. To correct that, the SEC required prospectuses to disclose the percentage of the offering that was going to be sold to managed accounts, to discretionary accounts, in order to set off alarm bells if it looked like you were stuffing. I think that's something you could do in this context as well. I think the simplest remedy is to have NASD standards that greatly restrict communications between underwriters and investment fund managers. If we find there's been a problem, then I think those communications should have to go through a compliance officer. That's essentially what we have now done with regard to communications between the underwriter and the securities analyst. We've set up a much stronger Chinese wall, and there may be a justification for it. I'm just saying the evidence isn't yet clear, but it certainly needs to be investigated.
Mr. Dodson, what do you think as a fund manager? Is increased regulation the solution, or do you think there's already too much regulation in the fund industry right now?
Well, what I think that what Professor Coffey said makes some sense from an objective point of view and from an abstract point of view, but it's, I think, hard to do from a practical point of view. The reason being is that if you put too many restrictions on, it's going to be hard for the portfolio manager to choose to invest in companies, perhaps IPOs that are underwritten by those investment banks. and of course, you do want them to be able to choose any security they want. So it's a real tough question. You don't want to put too many regulations on, but you want to have some mechanism for not being able to engage in the type of activity that may have gone on. So in my view, yeah, there probably are too many restrictions, but unfortunately the mutual fund industry has brought a lot on itself, and it hurts small fund groups like ours that have a huge burden. But on the other hand, you have to have stricter regulation because of the abuses. So it's a real dilemma.
All right, we only have a few seconds, and Mr. Seidel, I want to end it with you. Bottom line, do you think that the SEC should begin a formal investigation into this practice?
Yeah, I think it should. I think it should begin right away. I think this is an area that has long been overlooked. I am not a big fan of Chinese walls. I think the only Chinese walls are in China. And I think that there needs to be more scrutiny of this and possibly some retrenchment in terms of let's go back a bit and strengthen the prohibitions as opposed to ease them, which is what we've had happen for the last 20 years.
All right. Well, gentlemen, thank you very much for joining us. Mr. Seidel, Mr. Dodson of Parnassus, and John Coffey, Professor of Law at Columbia. We appreciate all of your time today, gentlemen.
Thank you.
Well, Bloomberg News analyzed 108,000 SEC